Anyway, the TI has some financial time value of money functions in it. And I'll show you where to go to get that. So if you're not real up on the computer, just follow along on the one I handed you. So you can open it, you can get there, just like open up Scratchpad, okay? And then hit the menu button. You see number 8? Yep, 8. And then just the finance solver, I call it TV, but whatever. Finance solver. And you have some fields that you can put things in, right? Maybe I'll do a quick example. Let's say that you have some money in an account. Let's say you have $5,000 in an account, right? And it's a 5% interest that you're earning, compounded monthly, right? So how many compounding periods per year would you have? 12, right? And it's 5%, and you're going to keep it in there for, I don't know, 10 years, like that, okay? So the N is the number of compounding periods altogether, right? So it'll be the number of years, 10 years, times the 12 periods, right? Yeah, or you can also just do 10 times 12, right? Like that. And I said the interest was, what did I say, 5% annual. So that's annual interest, right? But it's compounded monthly. Now, a couple of tricks here. Normally, you know how when you use a compound interest formula, you have to change the 5% to 0.05. You don't do that in here, right? See, which is I%. So you keep it as 5, but that's annual. We're compounding monthly. So what do you think you have to do? Divide it by 12, right? So this one up here is times 12. This one, the rate divided by 12, okay? Now, PV stands for present value, okay? Now, you had $5,000 that you removed from yourself and put into the bank, right? It went away from you for now, yes? And so we're going to consider that a negative cash flow, okay? If that makes sense. So the present value of that investment, PV, will be negative $5,000, right? Now, you're just leaving it sit there. You're not adding any money to it. Like there are times where you can add money to it as the months go along. We're not going to do that, right? We just want to see what it's worth at the end of 10 years. So down here is future value. You just go down here and hit enter. And in 10 years, that $5,000 will have grown to $8,235.05. Okay? So just a quick preview. I think we do this now. Maybe come a little more naturally to it. Has anybody ever used this in the TI before?
No.
Okay. And there's other calculators out there. There's specifically financial calculators, you know, designed from top to bottom, start to finish to do this kind of stuff. But this does just fine. Okay. All right. Well, that's that. Let's take a look at the book. So here's our notes. So real quick, the summary of this, chapter 1 and chapter 2 kind of blend together. Chapter 1 was about setting goals and making plans and stuff, right? And it did refer to financial statements. Does anybody remember what role the financial statements play in your financial planning? Yeah.
Financial statements are more your goals.
No, those aren't your goals. Like, so financial statements, there's a balance sheet, there's your income and expense statement, right? I'm pretty sure they mentioned it in chapter 1. The role, or in chapter 2, huh? Okay, the balance sheet will calculate your net worth, right? And there's an income and expense statement that tells you exactly where your cash is going out, how much is coming in, and if you have a surplus or a deficit, say each month or each year, right? And without those financial statements, you're really just kind of poking around in the dark when you're trying to make these financial plans, right? The financial statements tell you exactly where you are financially, right? And later on, as you implement your plans, right, and make a budget based on your statements and your plans, okay, then you go back and you revise your financial statements to see where you stand again, right, and say, okay, am I meeting my goals here or am I not meeting my goals? And if not, then you can revise your plans and your budget. Does that make sense? Okay, so the statements are kind of an important thing here, right? And the first one they talk about is the balance sheet, okay? So it's a lot like a corporation's balance sheet, except it's a little more personal, right? You'll have a listing of assets, which are, of course, all the things you own. And you remember what liabilities are?
That means that.
Yeah, it's the debts, right? It's the money that you owe, okay? So you list your current assets at current market value. Now, this is different than in a corporation's balance sheet. They list their assets at the original purchase price, okay? You'll list it at current market value, yeah.
How do you know that?
That's a good question, right? So some of that can be tricky. A lot of it's going to be an estimate, right? And maybe the numbers you put down are roughly what you purchased it for. Say, I don't know if it's jewelry or something, you know, I've got $1,000 worth of jewelry, or whatever. Yeah, I don't. You might, okay? Brady might do it. But say your automobile. Anybody know where to find the value of an automobile online? There's Kelly Blue Book, NADA book, that kind of thing.
Google it.
Yeah, but even more specifically, Kelly Blue Book is the main one, right? You can put in your make, model, year, and select all the options that your car has or doesn't have, right? And out comes the trade-in value and the private party sale value, which are generally different. Okay, so you can get an idea of what your vehicles are worth. You put in the miles. There's a place to put in how many miles you have, because as you know, more miles, less value. There are also websites that will estimate your home's value. Okay. Or maybe when you bought the home, you had, of course, you had an appraisal done, so probably have that document somewhere. Okay, but if it was 10 years ago, that figure is likely to be somewhat inaccurate. But it's not a bad starting point for it. So there's places to get values. Okay. So the balance sheet, it lists the assets and the liabilities, and the information in a balance sheet is just a snapshot in time, right? It's your current financial position at that moment in time. Now, the income and expense statement is like a running, moving set of data. We'll get to that in a minute, okay? And you'll group things into asset groups. Remember what liquid assets are? Cash equivalent. Right? And what I mean by cash equivalent is anything that can be converted to cash within 1 year, okay?
Like, for example,
savings account, maybe you have a CD that's due to mature in a few months, okay, you can count that generally as cash equivalent, okay? Anything that could be liquidated quickly, turned into cash, right? Then your investments, right? Your stocks, your bonds, or whatever you might have in your portfolio will be another group. Real estate, you'll group that together, so you probably will have a primary home, or if you're rent, you don't have that, right? Maybe you have a secondary home. Okay, some people have got a place down in Florida or something if they're lucky, right? The snowbirds, right? Personal property, cars, ATVs, I mean, all that stuff, all your electronic stuff, TVs, furniture, okay? And some of that, yeah, can be tricky to estimate, but, you sit and put some thought into it. Maybe you can go on, get on eBay and look up some of the items that you have and see what they're selling for, right? Or see what they have sold for, and you can get a much better idea of what they're actually worth. Okay? And then we go to the liabilities, which are your debts, right? And we're going to categorize those into the current short-term debts, okay? Like that are payable, with like the balance will be payable or paid off within 1 year, okay? Then you have, and by the way, let me get to this. An open account, also the book doesn't use this term, but this is common, revolving debt. Would be like your credit cards or home equity line of credit. So that's where there's not like one set amount that you borrow and you pay back on that principal every month, right? So if you use a credit card, you swipe it, $100 here, and then another $100 here, and then your payment's a little higher. The higher the balance goes, you pay it down, you can use it again, like without reapplying for a separate loan. Okay, so that's called revolving debt. They call it an open account. Okay, and they can be classified under current or short-term debts. Then there's a long-term debt, right? A lot of them is going to be maybe your car loan. You got another 3 years left to pay on that. got another 25 left on your mortgage, certainly they'd be under the long-term debt category. In worksheet 2.1, is what we're going to look at here in a minute. That's an example of a balance sheet. But also on this balance sheet, we have assets and liabilities, and then we can calculate our net worth. You just take the total of all your assets minus the total of all your liabilities, and you have a figure for your actual net worth, okay, a dollar value. And it's not your humanitarian worth, okay, it's just your financial net worth, okay? Now, you can either be what's called solvent or insolvent, right? So if your assets are greater than your liabilities, which one would you say you are? Solvent or insolvent? Solvent, right? Okay, means you have a positive net worth. And if your liabilities are greater than your assets, your net worth will be negative, yep, and so you'll be what's considered insolvent. Not the end of the world, right? You can go about repairing that. Not like the sun won't still come up tomorrow, but you know, if you are insolvent, you probably should start thinking about how to become solvent, right? And a balance sheet has a particular format, okay? We list our assets at fair market value, and let me see, let me go to the book. I think what I have here is something I already just talked about. Oh, another word for net worth, by the way, is your equity. You might hear that. Maybe that term's more common like on a corporation balance sheet, okay? Owner's equity, that kind of thing, but equity, net worth kind of mean the same thing. The balance sheet, if we go to page 32 in the book, I can't even find that. Nope, it's not that one. That's not, I had it open. No, here we go again. Too many things open. What else we got here? Highlighted. Talked about that. Assets, liabilities, net worth, they sum it up there. Then the balance sheet identity, we'll get to that in just a minute. Okay, here's a sample balance sheet for this Jack and Lily Taylor. Hopefully you read about them a little bit, right? So do you see over on the left side of the balance sheet? Those are your asset categories, right? So we have our liquid assets, right? And certain categories of liquid assets, okay? Then an investment category, and you'll list, you know, fair market value for any of those. And then total, so you total each category up separately. See how that goes? The real property, we're not confused about that anymore, right? What's real property?
Real property is just like, it's just land.
Land, houses, structures, right? Movable stuff, okay? Then your personal property, cars, recreational vehicles, you know, furniture, jewelry, artwork, whatever, other you can put in there. And like if you're making your own balance sheet, you can get more specific. Instead of putting other, you can put down exactly what you have, right? You type it in there. And then you total each of these asset categories up separately. And then you add up these subtotals, okay? So these are called subtotals. Oh, I can't write on that. And that's the bottom line total for the assets, yeah.
How do you decide what to put on your personal property? Like, for example, other, like, you find like one thing, the most expensive thing they have, or?
No, so they have a couple of lines here called other because maybe you have something other than jewelry, household, right? That's why I said, like, in one of the examples, he's going to have a coin collection we're going to do here in class. And you'll just write coin collection in here and what that's worth.
Oh, okay.
Okay. It's just for something that's not listed here. All right. So down here, and you notice how in finance, when we do subtotals and totals, the convention is when you do a subtotal, there's a single line under that, right? And when you do a bottom line total, usually put a double line under that. So not too critical, but that is the convention. Now over on the right-hand side, what do you see?
Liability.
Liabilities, okay? So like your utility payments, I would say those are like utility payments that are past due. Medical bills, you can see what they have here, right? And they set all this up in the reading, right? Jack and Lily, they described it in paragraph form, and you take all that information and put it in here. And then, so these are current liabilities, right? Due within a year, subtotal those. And you have your long-term liabilities, again, mortgage, right? If your car loan is going to be paid off next month, where would that go?
Short term.
Short term, right? Okay. But they may have a few more years left on that. If you borrow money for appliances or furniture, okay. Student loan, boy, that's optimistic. 3,800? I think not. Huh. Any other long-term? So this is another other category, okay? Looks like they borrowed money from their parents, right? Okay. And then we go bottom line total of the liabilities, okay? And directly after that, what are we going to calculate?
The net worth.
Your net worth, right? And how do you do that?
Minus the total assets. You do the total assets minus the liabilities.
260,000 minus 174,000 gives them a net worth of $86,765. Okay. So that's not too complicated, right? Everybody understand how you set this up? We'll do one here in a minute. Now, this down here at the bottom, this is what they are referring to as the balance sheet identity, right? So if you've done all this correctly, right, your liabilities, your bottom line liabilities, plus your net worth should add up to what?
Your total assets.
Your assets, okay? So your liabilities plus your net worth should add up to equal your assets, okay? All right. Does anybody have any questions on how to work a balance sheet? All right. So I do have an example. I think that's the next thing we're coming to. One. In-class exercise. So let's go to that. We're going to work on that here for a minute. Okay. So they want us to construct a balance sheet using the following information. Okay. Show whatever that means. We're going to be filling in. So you see these categories here? Cash on hand. Wouldn't that be a short-term liability? Right? Or short-term or current asset. And the credit card balance might be a short-term liability. Okay. So as you're looking down this list, think about where on the balance sheet they would go. And if you look on the next page, there's a balance sheet. So why don't we all take a minute and then fill this out, kind of the way they do in the book. If you want to refer to page 32, you can, okay? So fill out, and not all of these are going to be, like a lot of these are not going to be even used, okay? So don't feel compelled to say, oh, I've got an empty box or I got to put something in it. It's not necessary. They don't have it, right? They don't have this money market deposit, then nothing goes there, okay? So let's take a couple minutes and have you guys fill that out, and then we'll compare your balance sheet with what it should actually look like, okay? Yeah. Brian, what did you get for net worth?
13,330.
Ryan says 15,330. I'll write that down. Maybe I'll do the different color. I'll use this. 15,330. Let's see if anyone agrees with me. Anybody else have a figure?
That's 26,380.
I better maybe I'll write that down here. 26,380. Okay, so you guys definitely don't agree. Well, you have a net worth? You stuck on something? And still working. I'll give you guys a minute. So we got a 26,080 for net worth. Okay. All right. So let's see. He's revising his figure. What'd you say? 25,330?
Yes.
Okay. So it's different. So like when you get this figure, do this here, right? Do this identity calculation. And if it adds up to your total assets, you probably did it correctly. Well, I will tell you that, in fact, 25, yeah, it's supposed to be green. 25,330 should be the net worth. So if you guys didn't quite get that, go back and see maybe where you, and this is a really important financial exercise, by the way. I know it's kind of obnoxious and tedious, but the ability to go back and analyze and find your mistakes is really critical. If anybody here wants to be an accountant, I don't. Some people are cut out for that kind of thing. But one of the most common errors that can be made when you're doing something like this in the accounting arena is with data entry, right? Maybe you forgot to include an asset or a liability, right? Or you jotted it down wrong, or if you're on a computer, you sausage fingered the keyboard, typed it wrong. Found a mistake. So after that mistake, what was the net worth you had? 25. Okay. Well, let me put in what you should have in here, okay? So the cash on hand was $500, right? That goes there. And then we told, and that was it for liquid assets. What's that? All right. Now, one of the issues I might be running into is that their answer key was wrong. Let's see, cash on hand was saving. I don't see a savings. That's credit card.
Oh.
Credit card. Ah, maybe that, right? Bank credit card balance. That would not go under an asset, would it? Is that maybe part of where you guys?
Yeah.
Okay. What's that? Oh, yep. So 500 there, and then we had some stocks at $6,000 value. All right, in the portfolio, no bond or anything. So that was it for the investment category. So that totals pretty easily. And then under real property, had a few items, or no, just one. I'm sorry. For primary residence, right? I think that was at 60,000. And that was it there. So the total real property was 60,000. And now under personal property and car, vehicle, I think it was 7,500. And then they had some jewelry or whatnot, 1,200. And under other was in the coin collection, I believe, right? And that was 2,500. And I think that was it there. And so we total up the personal property. So that subtotal comes to 11,200. Everybody agree with that? Okay. And now we'll bottom line the asset side. So we just add up all those subtotals. That column there. And you should have 77,700. Is that about how your asset side looked? Right? Okay. Has anybody thought, like, from this side, has anybody found where they messed up? Was it like the bank credit card thing?
Yeah.
You all thought it was savings, maybe? So we didn't find your mistake yet, Sam? Huh? Somewhere else? Okay. Well, let's move along. Let's go over to the liability side. Current liabilities at utilities, 120. And their tax bill due was 500. Right? And then bank credit card balances, which is where oh, here. So here's an issue, right? If this 750 got moved from liability to assets, aren't you really doubling the error? Right? See what I mean? So then we had, okay, so now we can subtotal the current liabilities. It should come to 1370. All right. And now, primary residence, the mortgage on that is 45,000. Oops, put the comma in the wrong place. And their car loan was 6,000, so here's 6,000. I think we can subtotal that. So total long-term liabilities was 51,000. And now we bottom line the liabilities, add up those figures there, it comes to 52,370 right in here. Okay, so now we just subtract the 77,700 and the 52,370, and you get a net worth of 25,330. Okay, how about now, Sam? Yeah.
Do you have this one? Can you look at this? Because the last one says auto.
Auto payment.
You didn't put an auto there.
They snuck that in there. Okay. That's not going to be a liability.
Is it an asset?
That's going to go on the income and expense statement. What did you do with that 250?
Just don't even put it on.
Okay. Well, so that actually, so like maybe I guess before this example, I should have explained the income. So that is a monthly expense, right? And maybe from your reading, you realize that the balance sheet is a snapshot in time. It's like what your current position is. The income statement is like a running total over time. And that's your expenses that go out and the money that comes in. So that 250 should go on the income and expense statement. That makes sense? Where did you have it? Under liability somewhere?
Put it under liabilities.
So the liability is not the payment for the debt, it's the actual balance of the debt itself.
I just thought it was a due debt. They were laying on.
Yeah, it categorized as an expense, which would go on the other financial statement, the other, okay. And I didn't realize, so again, you guys know how I'm running this, right? It was this morning that I threw this in here real quick and didn't get a chance to look at it real good. Otherwise, I might have mentioned something about the difference between a liability and the payment on the line. So the liability balance itself goes on the balance sheet, all right? So think balance, right? The payments are an expense, they'll go on the income and expense statement. So, and the way to check this is do what?
Simply adding.
Take your liabilities, net worth, add them together,
To get the
and you need
right, to get the total assets.
okay? So that means everything's in balance here, okay? Now, would you say that whoever this person is solvent or insolvent? Solvent. Why?
Because their assets are higher than the liabilities.
Yeah, they have a positive net worth, so they are solvent. Okay. All right, so you kind of get a little better sense about how the balance sheet works now. Okay. All right, let me go back to where was we? So that was that. All right. Now let's move on to the income and expense statement, where that auto loan payment should have gone. I don't have another example for this. That's okay. There is one in your exercise. It's not that difficult. So this lists cash in and cash out. Okay. Over some time period. And that's the difference. And so the balance sheet is a snapshot. It's just a picture right now, at this very exact moment today of what your financial situation is. The income and expense statement is more of a moving set of data, right? It's over time. You get income, you get paid once a week at your job, right? That's over time. And you pay bills once a month, that's over time, right? And this records that. So it's not static, right? Like the balance sheet. And now we record, the book mentions cash basis, okay? Has anyone taken accounting in here? Mr. Kelly? All right, so you're not familiar with cash versus accrual. So if you're a business or a corporation and you're doing your accounting and your business books, you account based on what's called an accrual basis. So if you, let's say you have, you got to put inventory on the shelf, right? And usually you have a supplier, and what the supplier will offer you is an account payable, right? They'll give you 30 days. So they'll bring you the stuff to put on the shelf in your store, and then you have to pay them within 30 days, okay? When you account for that as a business, you have to put that in as an expense, okay, on your expense sheet. When you do it individually, you're only going to put on your income expense statement actual cash. Like if it's payable within 30 days and you haven't paid it yet, it doesn't go on here. Does that make sense? So it's cash basis, not accrual, right? And that's so the generally accepted accounting principles if you own a business is going to operate a little bit different than your personal statements. Okay. So income, that's the cash in part of the income and expense statement, right? All your wages, salaries, commissions, any other thing you get, right? Bonuses at work, any interest that you earn, like on your savings account. When we get to chapter 3, we'll have statement like a 1099 interest form that you'll record for tax purposes and dividends, inheritance, pensions. You get the idea, right? Getting alimony or child support payment. You know, that spouse. That's cash in. If you sell something, and say you sell your ATV or something like that for $800, that's cash in. That goes on there, okay? And you're going to use gross amounts on this, okay, before tax. So, like, you look at your pay stub, right? And does anybody ever look at their pay stub? Who has a job in here? You do? You ever look at your pay stub? No, look at your pay stub. Look at, maybe it's online. You ever look at yours? Right? You notice that you have the gross pay, and then your take-home pay is significantly less, right? Because they take stuff out of it, right? They take the federal taxes out, the state taxes, the FICA, Medicare, Social Security, all that stuff, okay? And then you get what's left. You will record on this the gross amount, right, before they take anything out. And those things that they take out will go in the expense column on this document. Yeah.
Is it possible to get all the money?
Yeah, well, okay. Temporarily. If you get a job, maybe you remember filling out what's called a W-4 form, right? Which tells how much you want, what you're going to claim, your taxes have withdrawn, and withholding each paycheck. If you claim exempt, then they don't take any withholding taxes out. And so you do get the whole paycheck. Well, scratch it. They do still take out the Social Security and Medicare. That comes out, but on federal and state taxes. So no, you won't. But then if you do claim exempt and you're not paying your withholding taxes throughout the year, then when you go to file your return, your tax return, by April 15th, then you're going to owe a lot of money. And it's going to be a surprise and a shock to you, right? You might owe a couple $1,000 because you hadn't been paying it through your payroll withholding all year long. So I wouldn't recommend that. Okay? I'm not going to, you're going to get me sidetracked, but I always like to get mine where I can, I like to owe the government a little bit when I go to file my taxes rather than people go, I'm getting a $2,000 refund. And I'm thinking, what, that's a gift? That's money you could have had all year. What? It's not like new money. It's money you earned. You could have had it. But I can't, like, give Uncle Sam an interest-free loan all year, on my dime and then have him hand it back to me and say, here you go, all right, bother you, whatever. So if I owe a couple hundred, I'm usually happy, right? Stuck it to the man. Okay. Anyway, so yeah, we're going to use gross amounts on this statement, okay? And there's going to be columns where you'll record the taxes and whatnot that you pay. So then you'll have a separate expenses, all your living expenses, right? Like groceries, taxes you pay, you buy assets, right? You buy tools down at Lowe's or something like that, right? Your personal care, your recreation, go to the movies, right? And how do you keep track of this stuff? Well, you use a ledger, okay? Does anybody have a checkbook from a checking account? Nobody? Does anybody have a checking account? Where do you get your money? Do you have direct deposit? What is it, deposit, checking or savings? So how do you get your money? You have a check, so you have a debit card, right? Okay, all right. And maybe, but if you order, it used to be, I guess it's not that common these days to get a book of checks and you write checks. And in the back of the checkbook would be a ledger where you record all your transactions, right? But if you're gonna fill out these documents accurately, as you go throughout your day and your week spending on things, you should record what it is you spent money on, right? All the cash that you laid out. And by the way, Kat, using your debit card is considered cash, right? Because it's coming directly out of your checking account, okay?
So
Yeah.
you should report all your purchase history.
Yeah, if you want to do this correctly, right, and have an accurate statement, it's a little bit tedious, right? But you should like record or keep your receipts and then throw them in every couple days or once a week, right? So you have an accurate idea of where your money's going out and when it's coming in. Okay, so the more you record and keep a good ledger, the better your income and expense statement will be for you, the more useful. That makes sense? Okay. So we have fixed expense, and by the way, there's software out there that does this quite well. Has anybody ever heard of Quicken? Okay, Quicken is a software that kind of replaces that thing in the back of the checkbook, the ledger where you record everything, and it'll generate all these documents. So it'll generate a balance sheet and your income and expense statement.
You put a number in there.
Yeah. You just type in, click on the date that you spent it, Lowe's, right? And then the amount, and maybe you can categorize it, right? Home repair or something like that, okay? So then we can separate things into fixed expenses, right? Those are expenses that you have that are the same every month, okay? Like your car installment loans. You guys know what an installment loan is versus we talked about revolving? Okay, so credit card's revolving, right? You can keep borrowing from it up to a limit without having to reapply. So an installment loan is you borrow once, okay, and you make regular installments every month back to the bank, okay? So those would be fixed expenses. Your cable bill, right? That's usually the same every month, right? Now, utilities might not be fixed, right? I don't know if you guys have ever seen your gas bill, your electric bill, okay? You ever have folks yell at you about turning the lights off?
Yeah, billing for how much you use.
Yeah, because that's a variable expense, right? You use more, it costs you more, right? So these are not constant. Your credit cards, right? They would be revolving lines of credit, not necessarily constant unless you're not using it, right? Utilities, your food's not necessarily constant expense, okay? You get the idea? So they fixed and variable expenses. Let's take a look at one. Well, let's see. So preparing it, you're going to record all your income cash in for the period. You want to maybe do it by the month or for a year. All expenses for the period by category, and you'll include taxes and payroll deductions, okay? And then you just subtract expenses from total income. You get a bottom line or a net cash flow, okay? Net cash flow, and you want that cash flow hopefully to be positive, right? Oh, and by the way, you'll either have a surplus or a deficit over that time period. Surplus would mean what's bigger than what?
I have a surplus of money.
Well,
Surplus
means what is bigger than what?
Yeah, surplus, you have more income than expenses.
Income is higher than expenses. A deficit, the expenses would be higher, so you have a negative, okay? And if you have a deficit, right, there's ways to handle that. Let's take a look at I think they have one in here. Of course they do. And is it, where are we? Okay, so that's that. We got all that, net worth, operation, balance sheet. It's got to be coming. Okay, so here's a sample income and expense statement, okay? So at the top here, you guys can see we got income and the different categories you might have, okay? And if you're married, you're going to list you and your spouse's income. Again, this is before taxes taken out, right? It's your gross. any bonuses you make. If you work on commission, like you're a car salesman, right, you list that. Interest, your savings account pays interest, usually not too much these days, but that could be in there. Dividends from stocks, okay, and then you just total it up, right? So total income. Then here's all your expenses, okay? By category: housing, utilities, food, okay? And that's why, this is why you should keep a ledger, right? If you want to do this right, you should keep a ledger of all your expenses as you go up through the month and the year, right? And that way you have something you can come back and put in here, okay? Clothing, right? You total that up and then you just subtract the two, all right? Now, would you say, this is Jack and Lily again, I guess? Do they have a surplus or are they running a deficit?
A surplus.
Running a surplus, right? Okay, so they have some extra money each month. What was the time period for this? So this is for the year, okay? So this is 12 months ending December 31st. So they probably kept the ledger from January 1st to December 31st, the whole year, right? And then totaled everything up in here. Right? So it's a pretty simple thing, okay? Another software you can use is Excel, right? You can make these things in Excel, which is, by the way, when you do your homework, those are Excel worksheets, and you can have it total it up automatically when you put numbers in, okay? All right. So real quick here, now that we have these financial statements put together, how do we use them to analyze things? Well, you guys, from all accounts, are pretty decent math students, right? You know about ratios, don't you?
Yep.
Right? When you calculate a ratio, you either put it into a percent or some number between 0 and 1. You can then compare it side by side with anything else, okay? You can directly compare things. So one of the first ratios they talk about is the solvency ratio. Now, 2 of these ratios come from the balance sheet figures, and the other 2 come from the income and expense, okay? So your solvency ratio comes from the balance sheet. You take your total net worth and divide it by the total assets. So what does the solvency ratio tell you? You're reading. Huh?
That exposes you to inflate all your debt with
Yeah.
cushion.
Right. How much cushion do you have? Like if your assets depreciate, because sometimes home values depreciate. What car values always do?
They change.
Unless they're like some classic, they depreciate, they go down, right? The stock market can crash, your portfolio can take a dive, right? And so if you have a big enough solvency cushion, right, it tells you how positioned you are to absorb that kind of a crash. Does that make sense?
Yeah.
Go to page 40. Take a look at cash out, offset. Yep, preparing. Yep. Nothing there. This talks about keeping good records like your ledger and whatnot. Ratio now. Okay. So here we go. So this is Jack and Lily Keller, whoever it was. So their solvency ratio, right? If you flip back and look at their balance sheet, total net worth 86.7 divided by their total assets, their solvency ratio is 33.3%. Okay, so that means if the value of their assets tanks by 33%, right, they're still in pretty good shape. So would you say their solvency ratio is a pretty decent number?
Yeah.
I would think so, yeah. Okay. Now let's go to the liquidity ratio. Okay. That's also from the balance sheet. So this is a measure of your ability to pay your current debts. Current debts are which ones? Payable
by short term.
within a year, right? Okay. So your liquidity ratio measures your ability to do that. Okay. And remember we talked about having an emergency fund?
Yeah.
If you have like a 6 to 9 month emergency fund, that will help this liquidity ratio because, I mean, by design, it's there to help you service debts if you can. Okay. And so that is the total liquid assets, right? That makes sense. If it's current debts, you want to look at your liquid assets divided by the total current debt. Okay. So it's just a ratio. And there's their liquid assets, 2285, current debts. So they have a liquidity ratio of 12.9%. All right. I'm not sure that they're in the greatest shape there. What do you guys think?
Yeah, I know.
So here's all like the cash and cash equivalent they have on hand, right? And here are the debts payable within a year. You might want to see that number be a little bit higher, I think.
Yeah, I always have
Okay.
emergency funds.
Yeah, right. Emergency fund would have probably helped that out. Okay. Now let's go to the ratios that come off of the income statement. We'll do this. We're almost to where I want to get to. So the savings ratio. Oh, this got. Okay, so formatting problem. This should be up underneath the savings ratio. So off the income statement, you're going to have the cash surplus or deficit there, your bottom line, right? If you divide that by net income, that tells you about your savings, right? So it's the relative amount of surplus you have at a given time, okay? Now for this, guys, for that ratio, you're going to use after-tax income, all right? So you have to take a couple, you have to take like your income off the statement and then subtract out of it the taxes, right? Just remember on the statement it's gross. You want to use net for this, okay? Now one big one that the banks use, and I use this all the time when I was a loan officer evaluating loans, it's a big one, is the debt to income. They call it debt service. We used to just call it the DTI, debt to income ratio. And that's an important one, especially if you want to get a loan, right? It measures your ability to pay your debts promptly, right? Your monthly debt payments, okay? And then when I calculated them at the bank, I would add in what would be the payment on this new loan and add that, okay? So you take your total monthly loan payments and divide it by your total gross income. And we generally prefer, when I was at the bank, to see that number be lower than, I think it was 36%, okay?
Why?
Well, because and every bank's going to be a little different, but that was our bank's comfort level, right? That was like if someone was above 30%, 36% on this, it means that if we give them a loan, then they could probably get into some trouble and not be able to pay it back.
Oh, okay.
Does that make sense? Okay. This basically tells you how able are you to pay back your debt, your loans, especially if we add another payment on there. Okay. All right. So that is that for today.